Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we'll take a look at trading gaps. Now, a gap is just simply what it sounds like. It's a gap at the opening of the session, and it's just an area where no trading was done. So, for example, I'll go ahead and zoom in on this particular gap here. We closed at the end of the 8th here in Walmart at 94.69. We opened at 94.64. So typically what you want to see on a gap is a clearance, a complete gap. It's not a partial gap. It's not like it opens up here. It's a full gap up. Otherwise, that type of gap, that although it gaps higher than the ending price of the candle from the previous day, it's pretty minor. So you want to see clearance there. And you got that. This is a pretty big open change. A lot of times these will happen with earnings, but they happen all the time anyway. So you can look at it as an actual trading strategy. So a lot of times what traders will do is they will do a handful of different things. They will enter right at the open and put a stop underneath the candle that gapped up from. It's kind of a wide stop, but this is a 15-minute chart. It's definitely doable, and you definitely made your money. Sometimes traders will try to buy right about halfway, filling the gap. Same stop loss placement, same theory. The one thing that you don't want to do, and we see a lot of retail traders that are new do this. Say you close here, you open here. Well, there's an old expression that gaps get filled, and typically that's true, but it doesn't happen that day necessarily. So unfortunately, some newer traders will try to short this gap with the idea of it's going to close. And you can see it worked for a little bit in this example, but most decidedly went against you in the end. So, like I said, gaps are things that happen all the time. This is a gap that came back about halfway and then rallied, and then even came back the next day at the open. It gapped right back down to that gap and then shot up like a rocket. Gaps aren't 100%. Here's a nice gap up that just never worked out. And that brings up the next bit. There are gaps down. You can see that we started there. We pulled back about halfway and then sold off pretty drastically. So the couple things that you might want to think about. Gaps are very volatile events, so I certainly wouldn't risk a lot on a gap. Maybe 1% of your account tops. They are reasonably reliable, though. But unfortunately, when you're wrong, you're going to be horrifically wrong, it seems. That's just an observation. There's no statistics behind that, but it just seems as if when gaps fail, they fail spectacularly. So what you want to do when it comes to gap trading is follow all of those rules that I suggested, but you also want to keep in mind that there are larger support and resistance levels at play. So I will go back to the daily chart. And you can see that there are gaps on the daily chart as well. I mean, they obviously will show up there. So for this gap down, we pulled back about halfway, and then we broke back down to this area. Now, we did break higher, but there's a couple things that I would point out. While this trade could have worked, selling here, taking your profit at the bottom of that candle, the most important thing to pay attention to on the daily chart is that we are in a big uptrend. So because of that, this gap isn't as appealing. Yes, it could be the beginning of a major downtrend, but it's easier to follow the overall trend. That's a theme that I keep pounding into your head, and with good reason. You can see that this is an area that had been resistance previously. It should be support, and lo and behold, that's exactly what it was. So the fact that we bounced from there shouldn't be much of a surprise. Now, alternately, as I continue to go lower, we have a gap higher in what has been a move higher for some time. And that is a little bit easier to trade. And where did we end up? We ended up right here, an area that was previous resistance. So that makes quite a bit of sense. Beyond that, the gap was pretty remarkable because we had this inverted hammer and then just gapped up massively from there. So that is a double bullish sign because this shows that the sellers just couldn't hang on to bearish pressure. That is a perfect type of gap to play. Now, as a day trader, you probably were out at the end of the day, but that makes sense. You can see that this works on all time frames. It doesn't matter if you're a day trader or not, but this gives you a sense as to how you should look at this. You say, okay, well, what's the trend? The trend's up. So in Walmart, we would be looking at gaps higher. Gaps lower, we won't trust as much. Now, granted, this was way back here that I was looking at, but you can see that clearly they have worked over time as I get closer and down into the uptrend. So gaps are very important, but follow the trend. Don't try to get too cute with them because they are much more believable if the market is already bullish of a story for a company. And then we get some type of confirmation or some type of event that makes people even more bullish and more money comes flowing into the marketplace.